think we're good. We're golden. We're going to sell stuff in this section of the chapter. Last time we were buying stuff. This time we're going to sell stuff. So you'll notice my little guy wearing a wholesaler hat. Remember last time how we were the retailer buying from the wholesaler? In this section, now we're going to be the wholesaler selling to the retailer. So it's going to be that same PW Audio thing. It's going to be the same dollar amount. It's just that the wholesaler is going to sell to the retailer. It would look the same when the retailer is selling to the customer. Okay. When we're selling, you either are buying things with cash or on credit. If someone is selling something and the buyer does not pay and says, bill me, is that AR or AP? AR. Because that means we've sold stuff and there's an asset involved here. We own the right to getting paid. Okay? Much like when with the AP side of it, there's some terms. Now you guys probably understand these terms a little bit better when you see it this time. I see terms 210 and 30. What does that mean? So if we're selling this stuff, we are the ones giving a discount this time. In other words, we're trying to encourage prompt payment. FOB shipping point, you also know what that means. Free for who? The person shipping. So in other words, us, we are shipping stuff out. And so we don't have to pay shipping, they do. Okay. So you'll notice we're still sending this, or we're still dealing with this 3,800. It's just that we're the wholesaler selling to the retailer who bought in the last section. What you need to know anytime you see the word sale or sold, there are two entries. Jeez. There are two entries. We first record the sale, and another entry, we record the cost. Because the stuff or the merchandise or the inventory was not free. Number one has to do with revenue. Number two has to do with stuff. I'll ask again, when you sell something, how many entries are there? Two. We're the wholesaler right now selling to the retailer. It would look the same if we're the retailer selling to a customer as well. So here we go. You guys remember the whole PW supply and SOX stereo? So what I do is just mark this up. This is the wholesaler selling to the retailer. So do you see how it's all the same $3,800 worth of stuff just like last week? It's just we're reversing our role. We're the wholesaler selling to the retailer. PW Audio records the sale of $3,800 worth on May 1st. Assume the merchandise cost $2,400. So I see the word sale, which tells me two entries. We first are going to record the revenue, then we're going to record the stuff. How did they pay? Because that our assets going up here. Did they give us cash or did they say bill us? They said bill us because of that little credit terms invoice. So what is going to be the debit if we sell something and they didn't pay us? Rather that we're going to bill them. AR goes up by $3,800. That asset goes up. Why do we own that? What part of that do we own? We own the right to eventually get paid. What's our credit when we sell something? Inventory is going to come next. Remember, we're dealing with the stuff on the next one. The stuff is part 2 of this. When we sell something, it's called sales revenue. Yeah. Because you're right though, inventory is going to be our credit in the next one, Jenna. But we're first dealing with the money, and then we're going to deal with the stuff. So 2 entries. When we sell stuff, what happens to inventory? Does it go up or does it go down? In other words, is it staying with us or is it leaving? It's leaving. So that asset's going to be a credit. Cost of goods sold is going to be our debit. And I'm okay with you putting COGS. Jenna is exactly right, though. Our inventory is our credit. It's just the first one's dealing with revenue, the second one's dealing with stuff. Let's think about this. This is an asset. It's going down. Usually when an asset goes down, that's kind of bad. But is that, in this case, a good thing? We needed that inventory to be available so we could make bank on it. Our inventory is only valued at $2,400, but we sold it for $38,000. Now remember, there was a lot that impacted inventory last week. We got it. We returned some. We had to pay to ship it, but then we got a discount on it. So there were some fluctuations there. Overall, there were some physical things that impacted it, but some on-paper things that impacted it as well. So I'm not too sad about this because I had inventory valued at $2,400. I sold it for $38,000. I'd be sad if I sold it for $24,000. I'd be even more sad if I sold it for $2,000, because then what was the problem? I didn't make money on it. What can I answer about this before we move on? Remember, tomorrow it's going to be better when we do this. But let me just backtrack and talk about it. When we sell something, we first have to record the money side of it or the revenue, and then we have to say inventory's gone. It's out of here. So how did they pay? What could this debit have been? It could have been a cash debit as well, but we saw the whole invoice there, so we know it was credit. And we made money. On the next one, these are 2 separate transactions. Cost of goods sold went up, but inventory's out the door. Last week we learned about purchases, returns, and allowances. What about when we sell stuff? Do you think they ever say we don't like the stuff? Yeah. So sales returns and allowances is basically the flip side of purchases, returns, and allowances. So this is when we're selling. This is when we are purchasing or buying. It's a contra account to sales. Think about when we have equipment for a minute. That's an asset. We have a contra asset that's called accumulated depreciation that offsets the value of equipment. You know that from last chapter. So equipment's rocking a debit balance. The contra assets rocking a credit balance. Same concept here. We have sales, which has a credit balance. But what we're seeing here, we have a contra sales account Well, and this should really be revenue. What kind of balance does that have? Because it offsets our revenue. So if we sell stuff and someone comes in and returns it, it's called a contra revenue account because we don't get to keep that money anymore. We just handed it back to them. Last week, I made some returns at Target. That return, when I came up there, and they were kind of crabby about it. Why? Because it's offsetting their revenue. What happens, though, if sales is not reduced? We still had $1,000 in sales. In this case, $3,800 worth of sales. We want to let that be our sales, but we're just going to have a whole nother camp that talks about what was returned. So instead of all bundling it together like they did with inventory last week, they're saying we're going to keep these two separate. Sales will be kept separate from sales, returns, and allowances. So here's the annoying part. When we're buying inventory, it all gets lumped together. When we're selling the inventory, in other words, sales, it actually has two different camps. So let me just give you easy numbers. If I sell $1,000 worth of stuff, but 200 comes back in, oh, not 2,000, 200. I did it again. There. Sales will always be 1,000. It's just that we're going to have this offsetting account to say, we really only sold 800, but we're going to keep those two separate instead of lumping them together. That is the most confusing part of this chapter. What does it look like from a journal standpoint? Prepare the entry PW Audio would make to return the $300 worth of bad stuff. So again, we see two entries. We have to say, okay, AR is reduced. They no longer owe that to us. But you know what? We have this contra revenue offsetting the credit balance. So if we sold $3,800, we're not going to say we didn't sell $3,800, and we're still going to say we sold $3,800. It's just that there's going to be another account, kind of like when we have equipment and accumulated depreciation. We're going to have another account saying 300 of it came back. When it came back, what also showed up? When the stuff came back and it's not defective, can we put it back on our shelves? We can. So what is going to go creep back up again? In the last entry, we sold it. Now some of it's back. Inventory is going to go up by 140 because that was the cost, and cost of goods sold is going to go down because we didn't sell them anymore. They're back. So inventory's back up, cost of goods sold went back down. So anytime we're selling stuff, we have two entries. If some of it comes back, we have two entries. This has to do with the revenue side. This has to do with the stuff. Assume the return goods were bad. Let me go back here. They weren't bad. If someone simply changed their mind, yeah, it's kind of creepy that we sent stuff home, and who knows, like, they can say that they didn't do anything to it, but who's to say they didn't let their dog run around with the shirt on, or I don't know. But when stuff is still good, we can resell it. What about when stuff is defective, is screwed up, isn't sellable again? So assume the $300 worth of sold goods were defective. What would this look like? Again, it's not saying, okay, we did this, now let's talk about bad stuff. No, this is like, assume the $300 came back, so it'd still be this. They no longer owe the 3 because they returned some of it. Remember, we're offsetting with this contra revenue account the revenue made. But instead of the stuff being okay, we're saying it's got a scrap value of $50. And I'm going to explain a scenario on that when I'm done with this. We still have inventory back, but it's substantially less. Remember, it used to be $140 COGS. They're saying it's $50 instead this time. Can I tell you a story about when this happens? Obviously, I like thrift stores, secondhand stores, because I'm a junker. Okay, so I use it as one place to get stuff. I've noticed Goodwill. Goodwill is in Wilmer, Goodwill is in Alec. It's more of a big box thrift store, if you will. Oftentimes, they have brand new Target stuff there. I know it's new because the Target tags are on it, and the little like Target clearance tags are on it. Do you know what I'm talking about with Target clearance tags? They're the orangey, reddish. Okay. Target must have a partnership with Goodwill because stuff is coming back to Target, and they must sell their stuff to Goodwill at a drastically reduced price. Because remember, before it was the $140. So they're saying there must be something wrong with this. We keep getting all these things returned. So instead of Target putting it back on the floor, Target is scrapping it and selling it to a place like Goodwill for $50 in this case. Does that make sense? So they're getting a little, it's better than nothing. It's better than throwing it away in their dumpster. But boy, 140 looks a lot better than 50. So that would be my best, like, real example that I could give you. Just like when we buy stuff on account and they give us a deal if we pay early, when we sell stuff on account and we get our customers to pay early, we offer sales discounts. Again, the same kind of terms we talked about last week. If terms were this, if they paid within 10 days, we'd give them a 2% discount. The rest of the net balance is due in 30 days. Okay, so if we're sitting here with this, it's not all masked as inventory like when we bought it. Rather, everything is separated out. So it's not all masked in inventory like when we're buying. When we're selling, there's 3 different camps. There's sales revenue. We've learned that there's sales returns and allowances, which is a contra revenue. And there's also sales discounts, which is another contra revenue. Sales has a credit balance, so these contra accounts have a debit balance to offset things. So if we did come in here and say, all right, we sold $3,800 worth of revenue, but $300 came back because it was crappy, or they changed their mind, and we gave a deal for them to pay their bill off. If you had to say what's your real net sales, it would be your credit minus those 2 contra debits. Is that in your notes? Good. So when we're selling, we have 3 different camps. Unlike when we're buying, it's all wrapped up awkwardly into inventory. Some of you might argue the inventory version's a lot easier because I'm just dealing with inventory. When we're selling, there's more hands in the cookie jar, but then the numbers go to the correct places. So what does it look like when we've sold something and we offer a discount because they paid early? Assume a stock stereo. So again, that's the retailer buying from the wholesaler. The wholesaler sold to the retailer. There were some terms Was it 210 and 30? I think it was. Way back on that sheet. Okay, so the balance is 35. Well, wait a minute. I thought we sold 38. Remember, there was a contra revenue account that said that we returned some. So the balance due, 3,500. And on the last day of the discount period, we paid our bill. AR is going down. Remember, this is for the wholesaler. The retailer owed us 38 originally, but then we offset that with the return. So the bill is being wiped out. We have a credit. When an AR pays their bill, what do we get? Money, cash. And we offered a discount that is a contra revenue that's got a normal debit balance to offset the revenue's credit balance. Remember, if you're confused, we're going to do this tomorrow. We're going to do the problems tomorrow. This was our original balance minus the return, and then the 2% discount because of the 210 and 30. I gave you one more handout. I would assume it's at the very back of your notes. If you're going, that's a lot of entries. We talked about buying it. Now we talked about selling it. On page 231, there's a really, really awesome breakdown of all of this. I actually gave you a printed version of what's on page 231. It's pretty great. And there it is. It's all of the transactions for selling stuff, and it's all of the transactions for buying stuff. So I thought I'd just give you a printed version of that just to kind of wrap up purchasing and selling. Awesome, awesome. I even wrote awesome in the notes summary. So this is where we're going to stop. We have 2 more sections to get through. Remember, I'm not going to really put any problems on the test about this next one, rather just vocabulary, being able to talk about how adjusting and closing entries are impacted by a merchandising business. We will spend the majority of this week, though, doing a harder version of an income statement, kind of like the harder version of the balance sheet from last chapter, harder version of the income statement here. So